Over the past decade, cryptocurrency has captured the imagination of investors and tech enthusiasts alike, with Bitcoin leading the charge as the original digital currency. Promising to revolutionize finance, disrupt traditional banking, and offer a decentralized alternative to government-issued money, Bitcoin quickly became a symbol of innovation and financial freedom. Yet as the years have passed, questions have emerged about whether these lofty ambitions have truly been realized. Today, we take a closer look at the current state of cryptocurrency and explore whether it has fulfilled its potential or fallen short of expectations. Bitcoin has seen a remarkable shift in its value over the past year. After reaching an all-time high of $126,000 in October 2025, its price has dropped significantly, now trading at just under $70,000 as of March 2026. This decline represents a loss of nearly 50% from its peak, highlighting the extreme volatility that continues to define the cryptocurrency market. For investors, these numbers underscore both the risks and unpredictability of holding Bitcoin, as market corrections, regulatory changes, and shifting sentiment all play a role in shaping its trajectory. While some see opportunity in the fluctuations, others are reminded of the challenges inherent in investing in digital assets. The collective market capitalization of cryptocurrencies has seen a dramatic drop, falling from $4.4 trillion at its peak to just under $2.2 trillion. This sharp decline reflects not only the volatility within the crypto market, but also the influence of broader economic factors. Interestingly, the falling value of the US dollar has somewhat softened the blow, making the losses appear less severe than they truly are when measured in purchasing power. As a result, while the numbers might not look as alarming at first glance, the real impact on investors and the overall market is more significant than it seems. When we look at whether cryptocurrencies like Bitcoin have succeeded as stable currencies, the picture is mixed. Over the past year, Bitcoin and other major tokens have lost nearly half their value, which means their purchasing power has dropped dramatically. This kind of volatility is closer to hyperinflation than to the stability we expect from traditional currencies. While some hoped crypto would serve as a reliable alternative for everyday transactions, these sharp swings in value make it difficult for people to use them confidently for buying goods or services. In practice, the instability has limited their effectiveness as true currencies. While cryptocurrencies were initially envisioned as a revolutionary alternative to traditional payment systems, several practical challenges have limited their widespread adoption for everyday transactions. Network delays can cause payments to take minutes or even hours to confirm, making them less convenient than instant card payments. Transaction costs, especially during periods of high demand, can spike dramatically, sometimes making small purchases impractical. Additionally, scalability remains a major hurdle, as most blockchains can only process a limited number of transactions per second compared to established payment networks like Visa or MasterCard. These issues collectively make it difficult for crypto to compete as a mainstream payment method. Bitcoin was often promoted as a digital store of value, with many comparing it to gold, the traditional safe haven asset. However, recent market trends have raised questions about its reliability in this role. Over the past year, Bitcoin's purchasing power has dropped significantly, and its ability to retain value has been challenged by sharp price swings. For example, while one Bitcoin could buy 32 ounces of gold last year, today it can purchase less than 12 ounces. This volatility makes it difficult for investors to view Bitcoin as a stable or safe investment, especially when compared to gold's long-standing reputation for preserving wealth. One of the founding ideas behind cryptocurrencies like Bitcoin was to create a decentralized financial system, free from the control of central authorities and governments. However, as the industry has grown, much of the trading now happens on centralized exchanges, which operate more like traditional banks than the peer-to-peer networks originally envisioned. The possibility of government bailouts for these platforms further blurs the line, as it introduces the very oversight and intervention that crypto was designed to avoid. This shift raises questions about whether cryptocurrencies are still fulfilling their original promise, or if they've become just another part of the mainstream financial system. Throughout its history, the cryptocurrency market has faced several dramatic crashes, each testing the industry's resilience. Notable events include the collapse of Mt. Gox in 2014, when the leading Bitcoin exchange was hacked, resulting in the loss of hundreds of thousands of bitcoins and a sharp decline in market confidence. Years later, the FTX scandal in 2022 shook the industry again, as one of the largest crypto exchanges filed for bankruptcy amid allegations of fraud. Despite these setbacks, the crypto market has shown a remarkable ability to recover, often rebounding to new highs after periods of turmoil. These cycles of boom and bust have become a defining feature of the crypto landscape, underscoring both its volatility and its enduring appeal to investors. The cryptocurrency world is currently grappling with a crisis of legitimacy, as recent waves of compliance and regulatory changes have shaken its core identity. For years, crypto was seen as a rebellious alternative to traditional finance, promising decentralization and freedom from government oversight. Now, with increasing regulatory acceptance and integration into mainstream financial systems, that original narrative is fading. Instead of fighting against the establishment, cryptocurrencies are being shaped by it, leaving many to question what truly sets them apart. This shift has sparked debate within the community about the future purpose and value of digital assets in a world where they are no longer outsiders. The current downturn in the crypto market isn't the result of a single event, but rather a combination of persistent challenges. Unlike previous crashes that could be traced to clear triggers like exchange hacks or regulatory bans, today's market faces a mix of economic uncertainty, evolving regulations, and shifting investor interests. These headwinds include tighter monetary policy, increased government oversight, and competition from new speculative opportunities like AI and online gambling. Since these factors are deeply rooted and interconnected, they're not expected to fade away quickly. As a result, the crypto market is navigating a period of sustained uncertainty, making its future trajectory harder to predict. This time around, the decline in cryptocurrency markets stands out because there's no obvious event to blame. In past crashes, a specific incident, like a major exchange hack or a regulatory crackdown, often set things in motion. Now, the market is facing a downturn without a clear catalyst, which adds to the uncertainty. Without a single trigger to address or move past, predicting when or how recovery might happen becomes much more difficult for investors and analysts alike. Over the years, the cryptocurrency market has seen a noticeable shift in its investor base. Early on, passionate crypto enthusiasts drove much of the excitement, often motivated by the promise of rapid gains and a belief in decentralized finance. Recently, however, many of these fanatics have moved on, seeking new opportunities in legalized sports betting, prediction markets, and crypto casinos. This change has altered the market's dynamics, as the core group that once fueled liquidity and promoted the industry has dwindled. As a result, crypto is increasingly treated as just another speculative asset, with new forms of gambling offering similar thrills and risk profiles. Cryptocurrency has long attracted those seeking high-risk, high-reward opportunities, drawing clear parallels with gambling and prediction markets. Many investors are enticed by the potential for rapid gains, often treating crypto trading less like traditional investing and more like placing bets on unpredictable outcomes. The rise of crypto casinos and legalized sports betting has only blurred these lines further as people look for quick wins in both arenas. This speculative approach means that, for many, the thrill of potential profit outweighs careful analysis, making the crypto market resemble a digital casino floor more than a conventional financial market. Financial nihilism has become a defining trait among many crypto investors, especially those drawn to the promise of rapid gains. Faced with traditional markets that seem slow or inaccessible, these individuals often turn to cryptocurrencies as a way to take big risks for the chance at life-changing rewards. This mindset fuels a culture where speculation and high volatility are not just accepted, but celebrated. As a result, the crypto ecosystem has evolved into a space where quick wins and bold bets shape both market trends and community attitudes. Over time, this appetite for risk has influenced everything from trading behaviors to the very narrative that surrounds digital assets. In recent years, the introduction of exchange-traded funds, or ETFs, and the growth of regulated exchanges have made it much easier for everyday investors to access cryptocurrencies like Bitcoin. These products allow people to buy and sell crypto through familiar financial platforms, often without needing to manage digital wallets or navigate complex blockchain technology. However, this increased accessibility comes with a trade-off. The original vision of a decentralized peer-to-peer financial system is giving way to more centralized control by major financial institutions. As a result, many new investors treat crypto as just another asset in their portfolio, rather than a revolutionary alternative to traditional banking. This shift has sparked debate within the community about what the future of cryptocurrency should look like. In recent years, new financial products like covered calls and derivatives have become increasingly popular in the cryptocurrency market. These tools allow investors to generate artificial returns by selling the right to buy their crypto at a set price in the future, often in exchange for a fee that is paid out as a dividend. However, this strategy can cap potential gains and, more importantly, introduces extra selling pressure when prices fall. As market makers hedge their positions, they may need to sell more of the underlying asset, which can push prices even lower. This dynamic adds another layer of complexity and volatility to an already unpredictable market. In its early days, cryptocurrency was fueled by a powerful narrative, a promise of revolution against traditional financial systems and a vision of decentralized, borderless money. This anti-establishment appeal attracted a passionate community, eager to challenge the status quo and imagine a new financial future. Over time, however, as regulatory acceptance grew and mainstream institutions embraced crypto, much of that rebellious spirit faded. Today, with most barriers removed and adoption widespread, the industry struggles to offer a new, compelling story. Without a clear vision to rally behind, many investors find themselves questioning what comes next for crypto. After years of anticipation, many of the promises that fueled the rise of cryptocurrency have finally been fulfilled. Regulatory hurdles have eased, mainstream financial institutions now offer crypto products, and governments have largely stopped resisting its integration. Yet despite these victories, the market hasn't delivered the lasting value that early supporters hoped for. The excitement of overcoming obstacles has faded, revealing that widespread adoption and regulatory acceptance alone aren't enough to sustain meaningful growth or utility. Instead, crypto remains mostly a speculative asset, with its original vision diluted by the realities of mainstream finance. Cryptocurrencies have long been seen as exciting opportunities for speculation, attracting investors who hope to profit from rapid price swings. Despite promises of revolutionizing finance, most major crypto assets are still used mainly as vehicles for trading and investment, rather than for everyday transactions or practical applications. While there are some niche uses, the majority of activity centers on buying and selling, often with the goal of cashing out at a higher price. This speculative focus has made the market highly volatile and sensitive to shifts in sentiment, leaving real-world utility largely in the background. Recently, artificial intelligence has emerged as a major competitor to cryptocurrencies, especially when it comes to attracting large-scale investments and resources. Big investors who once poured money into crypto are now shifting their focus to AI, drawn by its rapid development and broader applications. This shift has had a noticeable impact on the crypto industry, particularly in mining operations. As more energy and specialized hardware are redirected toward AI data centers, crypto mining becomes less profitable and network stability can suffer. The result is longer transaction times and higher fees, making it even harder for cryptocurrencies to fulfill their promise as efficient payment systems. As mining cryptocurrencies like Bitcoin becomes less profitable, the costs associated with maintaining these networks have risen sharply. Higher energy prices and the need for specialized hardware mean that miners are spending more just to keep the system running. At the same time, the reliability of these networks is starting to decline. Users are experiencing longer transaction times and higher fees, which undermines the argument that crypto can serve as an efficient payment system. These challenges raise important questions about the long-term sustainability of cryptocurrency networks. When we look at the environmental impact of new technologies, both cryptocurrency mining and artificial intelligence stand out for their significant energy consumption. Bitcoin alone uses around 150 terawatt-hours of electricity per year, which is on par with the energy demands of AI data centers worldwide. This immense power usage translates into higher carbon emissions and increased strain on energy grids. Additionally, Bitcoin mining generates about 30,000 tons of electronic waste annually, as specialized hardware quickly becomes obsolete. These factors not only contribute to pollution and resource depletion, but also raise important questions about the long-term sustainability of our digital future. The crypto market is fundamentally a zero-sum game, meaning that for every winner, there must be a corresponding loser. When someone profits by selling their cryptocurrency at a higher price, it's because another participant bought in, hoping to do the same in the future. This cycle relies on new investors entering the market, often driven by the promise of quick gains. Unlike traditional investments that can generate value through dividends or interest, crypto's value is largely determined by speculation and shifting sentiment. As a result, the market's gains and losses simply shift between participants, rather than creating new wealth overall. Fraud and crime remain significant challenges in the world of cryptocurrency. Despite advances in technology and increased regulation, the industry continues to face issues like money laundering, scams, and rug pulls, where developers abandon projects and disappear with investors' funds. These activities not only undermine trust, but also make it difficult for legitimate projects to gain credibility. While efforts are underway to improve transparency and security, the decentralized nature of crypto still makes it a target for bad actors. As a result, caution and due diligence are more important than ever for anyone participating in this market. Today, the cryptocurrency market has shifted from being seen as a reliable store of value to acting more as a barometer for speculative cash in the financial system. Rather than representing long-term savings or stability, crypto prices now tend to mirror the ebb and flow of risk-taking among investors. When there's an abundance of speculative capital searching for quick gains, cryptocurrencies often surge. Conversely, when caution prevails, the market can experience sharp declines. This transformation highlights how crypto has become closely tied to broader trends in investor sentiment and market liquidity, rather than serving its original promise as digital gold. While the stock market has been hitting new highs, with the Dow recently surpassing 50,000 points, the cryptocurrency sector is facing significant challenges. Bitcoin, for example, has seen its value drop sharply from its previous peak, reflecting a broader trend of volatility and uncertainty in the crypto market. This contrast highlights how traditional equities are benefiting from renewed investor confidence and favorable economic conditions, whereas cryptocurrencies are grappling with regulatory changes and shifting sentiment. The divergence suggests that investors are seeking stability and proven returns, favoring stocks over riskier digital assets. Ultimately, these patterns reveal how different asset classes respond to economic shifts and the evolving landscape of global finance. In summary, the recent turbulence in the cryptocurrency market has led many to reconsider the legitimacy and long-term prospects of digital assets like Bitcoin. Factors such as extreme price volatility, shifting investor motivations, and increasing regulatory scrutiny have all contributed to growing skepticism. The promise of decentralization and financial revolution now seems overshadowed by speculation and the influence of traditional financial institutions. As the industry faces new challenges and fewer clear milestones, some are left wondering if crypto was simply a bold experiment that has run its course. Ultimately, the debate continues over whether these digital currencies will adapt and find lasting value, or remain a cautionary tale in financial history.